Have you ever been following a stock and just when you buy it, it immediately reverses and heads down? Or on the flip side of that, have you ever been holding a stock that's been moving down against you and you keep thinking, just waiting for it to bounce, waiting for it to turn around so you can get back out at even. And finally, when you can't take it anymore, when you can't risk losing any more money than what you already have, you sell it and get out and it instantly reverses and bounces back up. Or your account balance. Do you have wild swings in your account balance? Are you up, 20, 30% at times and then give it all back? Look, almost every trader should answer yes to these questions at some point in their trading. It's happened to pretty much everyone. So if this sounds like you, stick around for this video because we're going to be talking about the psychology of trading. Look, most people don't even realize it's your emotions that are costing you money over the long term. In this video, we're going to go over the 4 primary fears that you need to understand in order to be a successful trader. So stick around. Look, 95% of the trading errors that you're most likely to make, that's just going to cause money to evaporate right in front of your eyes, 95% of those errors are going to stem from your attitudes about being wrong, your attitudes about losing money, your fear of missing out, and your fear of leaving money on the table. Those are what we call the 4 primary fears of trading. It's really emotions, not intellect, that's going to make or lose you money in the market over the long term. Look, intellect will make you money in some individual trades. Obviously, to be a good trader, you need to have good technical analysis skills. You need an effective strategy for when to take trades, when to get in and when to get out of trades. And you need a well-defined risk management plan. All those things need to be in place in order for you to be successful at trading. However, what most traders don't realize is that it's the emotions that cause you to lose money when the market turns against you. In order to stick with your strategy and to follow your risk management, you really need to have the right mindset. If you're not having the right mindset, or if you don't understand how the psychology of trading works, it's going to cause you to deviate from your strategy. Any little loss or any little setback, and you'll start to deviate from your plan. And the problem with most traders is they don't even recognize when they're trading emotionally. So in this video, we're going to go over the 4 fears of trading and how to recognize them and what to do to manage them. But before we jump into that, let's go over some general market phases first. So hopefully most of you are familiar with the Wyckoff cycle. If not, I'll go over it here real briefly. So basically there are 4 market phases, and you could look at any chart, any index, and if you zoom out far enough, you'll be able to identify where these 4 phases are. So the 4 phases are, the first one being accumulation. So accumulation is down here. It always happens after the end of a bear market or after a large pullback. You'll get this accumulation phase. And basically it's where the stock trades relatively sideways, pretty much within a trading range as the institutions are starting to build their positions in the stock. Now, as the institutions build up their positions, they start competing against each other for more shares. And as they do that, that pushes the stock price outside of this trading range, and you get this first initial move up. Now, after this first initial move, usually you'll get a pullback back down to the top of the range to test it from the top side. And if that's successful and you get a bounce off of there, that now takes you out of the accumulation phase and into the markup phase. Now the markup phase is this area here, and this can last anywhere from months to several years. And this is basically the phase where the institutions are buying up as much stock as they can. They have a goal of how much stock they want to buy in any individual company. And during this time, they're all competing with each other to try and get the best price and try and fill up their positions as best as they can. So that's what happens during this markup phase. Eventually, they get to the point where they have as many shares as they want. They're really not looking to buy anymore. And by now, they actually have a lot of profit in the shares that they bought, way back down here. So now they're actually looking to lock in some of those gains. And that's where you have the distribution phase. So in the distribution phase, it looks very similar to the accumulation. Obviously, the stocks, trade relatively sideways, but this time the big institutions are actually lowering their positions. They're trying to get rid of their stock, but they're trying to do it discreetly. So what you get is these moves within a range, every time the stock price moves up, the institutions will sell. Once they sell, they'll stop selling, wait for the price to come back up again, then they'll sell again. And I mean, this can go on for, again, several months in the distribution phase, till eventually, again, the institutions begin competing with each other. Who's going to sell first? Who's going to lock in their profits first? And as they do that, the stock price starts to accelerate to the downside. And once again, you'll get a back test of that range. And if that fails, then now that puts us in the final phase, which is the markdown phase. So the markdown is basically what you get in a bear market. The institutions are trying to dump their stock as quick as they can, and it pushes the price down. And again, this could last, several months to years. The other diagram I'd like to go over just real quick here is during those same phases of the market, this is what typical retail traders will feel during those phases. And as we go through this, you'll start to notice that really at each of these stages, the emotion you're feeling is the exact opposite of what you should be feeling. So let's start with here. As we're in the markup phase and stocks are moving up, retail traders start to get some optimism. We've been in a bear market for a long time. Their accounts are probably down quite a bit. And as the stocks start to recover and as the stocks start moving up again, you start to see some of this optimism. The problem is the optimism starts pretty late. It doesn't start near the bottom. It starts usually about halfway up the markup phase. From there, now their account balances are going up. They're making some money again. They start to get some excitement. The excitement turns into thrill. And here's where you're at a market top, is basically where you get that euphoria feeling. So how do you know when you're in this stage of euphoria? Well, basically, it's at the point where every retail trader thinks that they're a professional, and they've been making money throughout this last part of the cycle, and they basically think they're an expert at what they're doing. Everyone thinks they're a trader. Basically, is the way to explain the euphoria phase. Let me just give you a real quick example of euphoria. So during the bull market of 2020 and into 2021, I was at a barbershop, getting my hair cut, and the owner who cuts my hair, he was telling me how he's having a lot of trouble hiring people, that his longtime employees were quitting, and he was talking about one in particular who had quit to do day trading full time. Now, this person had never traded before prior to 2020, and in 2020 they had made so much money that they felt they knew what they were doing, to the point that they actually quit their job and thought they could day trade full time. There's no better way to explain euphoria than an example like that. So after euphoria, that's when we start getting the distribution. So now stocks are coming down a little, and the retail traders start getting some anxiety. They're maybe not doing quite as well as they used to, and maybe gave back some of their profits and are feeling a little bit of anxiety. As the stocks go down a little lower, you get to this denial phase where you don't want to believe that the market is over. You don't want to believe that the bull market is over, and that we could possibly be in the start of a bear market. As stocks drop even further, if you look at where this is compared to on the chart where most retail traders got in, you're almost back to even. And you're definitely starting to feel some fear at this point. The next stage is desperation. Now you're starting to, how am I going to make my money back? I gave back all these profits. Then you get lower. So now you're even lower than where you started, and that's where the panic sets in. Retail traders start to panic. The markets, keeps going down. There doesn't seem to be any end in sight. And finally, that's where you get capitulation. Capitulation is where the last of the retail traders sell. It's basically at the point where, they've held through this entire downturn, waiting for the market to bounce, basically trading on hoping for the market to bounce. It's not doing it. And finally, as you get into this panic, everybody decides to sell, and you get this huge capitulation. The market drops, and now all the retail traders are out. And that is exactly when the institutional investors start buying the stock up again. So then we get into this accumulation phase. Stocks start coming up again, but obviously the retail traders are still in depression. Usually at this point, they're not looking to get back into the market yet. Now, as the market moves up a little more, now you get into this hope. Maybe it'll bounce back. Maybe this will actually work. Get a little higher. Now you're starting to feel a little bit of relief. Maybe there were a few positions that you held onto, and Now you're starting to feel a little bit of a relief because it's starting to get back to your, hopefully close to your break even at least point. And finally, as it moves up a little more, we're back to this level of optimism. So as you can see, basically these emotions are the complete opposite of what you should be feeling at each of these times. Here, instead of euphoria, that's where you should be thinking, this is a market top. I need to get out. Whereas euphoria is, this is awesome. Let's pile in, let's go all in. And, it's the complete opposite of what you should be doing at that point. And same thing down at the bottom. After holding through an entire bear market, the capitulation is the exact opposite of what you should be doing. When you should be buying the bottom, or at least waiting for this type of recovery and stocks to start moving up so you can get back in. It's the worst time that you could be selling, but it's also the time when most retail traders do sell. All right, so let's get back to the 4 fears of trading. So the first fear, the fear of being wrong. Look, nobody wants to be wrong, and nobody wants to admit that they're wrong. But you got to ask yourself this question. Do you want to make money, or do you want to be right? And it kind of seems contradictory, because if you're right, you're obviously going to make money. But what this is really saying is, look, do you want to take trades that have a high probability of success and only take those trades and make money? Or do you want to try and be right on every single trade that you get into, and if the stock moves against you, not admit that you're wrong, instead keep holding the stock, and now you've just turned what was a really small loss into a big loss? Look, conviction or stubbornness doesn't belong in trading. That's basically hope trading, and it's going to cost you money in the long term. Now, all that being said, it's human nature to not want to be wrong. We all have egos. Nobody wants to admit that they're wrong. And when you talk to other traders, do you ever hear traders talking about their losing trades? Traders only talk about their winners. They very rarely, if ever, talk about their losing trades. Well, why is that? There's 2 reasons for it. One is what we're talking about. Nobody wants to be wrong, so nobody's going to talk about their losing trades. The second one, though, is if you're talking to professional traders, they don't dwell on their losing trades. A losing trade, that's just the cost of doing business. As long as your losing trades are small and your winners are big, those losing trades are really insignificant. So that's why you'll never hear professional traders talking about them, because it might have been a 2-3% loss where they just get out of it and put their money somewhere else, and now they're making 15-20%. So those are the 2 reasons why you'll never really hear people talking about their losing trades. So in order to be a successful trader, you really need to change your mindset about what it means to be wrong. When you get into a trade, say you're following your trading strategy and you get in at just the right time, that trade might only work, maybe 60% of the time, maybe 70% of the time if you have a really tuned in strategy. So that still means you're going to be wrong 30 or 40% of the time. But you can't look at it as being wrong. As long as you follow your strategy, and as long as you follow what your plan is to get in and out of the stock, then you've done everything correctly. And you're never going to have a strategy that's going to be correct 100% of the time. But what you don't want to do is, on those 30 or 40% of the time when you're wrong, what you don't want to do is try and hold on longer than what you should. In other words, if you had a plan on getting into a stock and you had a plan on where you're going to get out, once the stock gets to that price, you don't want to change your exit strategy. And a lot of people will change their exit strategy just because they don't want to be wrong. So they'll move their stop lower thinking, you know what, I'm going to give this stock a little more room and wait for it to bounce. But the problem is it doesn't bounce, and now you've just turned your small loss into a big loss. Which brings us to our next fear of losing money. So the only thing worse than being wrong is losing money. People are extremely emotional about money. It's your hard-earned money that you've worked for. But more importantly, and this is absolutely key, the emotional response from losing money is significantly stronger than the emotional response from making money. So I really want you to think about this for a second. Pick whatever number is significant for you, but I'll just throw out some nice even numbers. If you're, let's say in a week you're up $1,000. That's not really life-changing, right? You'll probably be happy that you're up $1,000, but it's not like you're going to go out and celebrate. Now, on the flip side of that, if you are down $1,000, your emotional response to that is going to be a lot stronger. Making $1,000, okay, that's nice, no big deal. But losing $1,000 is really going to upset you, right? So again, you need to pick whatever number works for you, depending on what your portfolio balance is. 1,000 might not be the right example for you, but the point of this is that whatever number you pick, you are going to have a much stronger emotional response to losing that amount of money than you will to making that amount of money. So the key is, when you make that much money, you want to lock in those profits and then go on to the next trade and make that amount again. And that's how you're going to be successful over time, is by compounding all of those gains, time after time after time. The problem is, retail traders will often allow small losses to turn into big losses. Now, the reason they do that, again, it's kind of these two fears combined, the fear of being wrong and the fear of losing money. If you're down, say $300, $400, $500 on a trade, instead of just taking that loss and walking away, if you move your stop lower to give the stock more time to bounce, well, now you just might have turned that $300 loss into a $1,000 loss. And now that's going to cause you to have less confidence in your trading strategy. It's probably going to cause you to start taking bigger risks, because now you need to make that money back. And taking bigger risks is going to end up with even bigger losses. So you can see how the psychology of trading, how it just kind of spirals down from small losses to bigger losses to even bigger losses. And before you know it, you've given a large percentage of your account balance away. So the third fear I want to talk about is the fear of missing out. Now, this one was always a difficult one for me. And so in these four, you got to go through them. Different people are going to have different responses to each of these, right? For me, the fear of missing out was always the most difficult one to manage. And basically what that means is, let's say you've been watching a stock, and maybe you've been watching it for the last several weeks or maybe even months, and you're just waiting for that perfect setup, waiting for that perfect entry, and for whatever reason you just miss it. Say you weren't able to look at it that day, for whatever reason. Maybe you missed the alert that you got. For whatever reason you missed the entry, and so let's say a couple days later, or sometimes even the next day, you're looking at the chart and you realize, oh man, I've been watching this thing for weeks and I missed it. What the undisciplined trader will do is still take the entry and still buy the stock. Now, making undisciplined entries just because you missed the correct entry, what's that going to do to your risk management plan? There's one or two things that you're going to have to do now. Either you're going to take on way more risk than you should, because you're going to buy the same position size, and you're going to put your stop where you should put your stop, where it technically makes sense based on the chart. So you're going to put your stop in the correct spot, and now you're taking on way more risk than you should on any one trade because you didn't get in at the correct entry. You got in too high. The other thing that you might do is you're going to put too tight of a stop. So because you had a bad entry, you had an undisciplined entry, so now you're going to put your stop somewhere not based on the technicals of the chart, but somewhere higher up than where it should be, because you don't want to take on more risk. Say you want to take only 4 or 5% risk. Well, in order to do that, now you got to put your stop in the wrong spot. Well, if you do that, you now have a high probability of getting stopped out. So, okay, you might not lose a huge amount of money, but you've just made a trade where you have a high probability of taking a loss on whatever risk you set up with your stop. So neither one of those scenarios are good. So avoid taking undisciplined entries. Look, if you miss an entry, just accept the fact that you're going to miss it. Look, you're going to miss a lot more trades than you're going to take. That's just a fact of reality. It's impossible to see every trade. And even if you're watching a stock and you have your alerts set, it's still possible you might miss the actual breakout or whatever you're looking for in your trading strategy. So it's important to just accept the fact, look, if I missed it, and move on to the next one. The reason people have this fear of missing out is sometimes when you look at a trade, you think, man, this is my last chance to make money. This is the one. This was going to be my big one. And look, there's going to be lots of other opportunities. This is definitely not the last opportunity. It's definitely not the last trade. So if you miss it, you miss it. Just move on and look for the next opportunity. And the final fear we're going to go over today is the fear of leaving money on the table. Look, let's say you're in a stock, You followed your strategy, you got in at just the right time, you had a really good entry, you had your stop set correctly, and now the stock price has moved up, way in your favor. Well, a big fear that traders have is selling too soon and having the stock continue up without them. In other words, leaving money on the table. So you need to make sure that before you get into any trade, you always want to have an exit strategy for profitable trades. And I talk about this in one of my other videos. I'll post the link right here that you can go look at. But you need to have an exit strategy both for losing trades and for profitable trades. The reason for that, you never want to let a profitable trade turn into a loss. But at the same time, you don't want to limit your profit either. So what you want to do is you want to use your chart for resistance levels. You want to move up stops, maybe use staggered stops based on the charts. You want to try and stay in a stock as long as you can, as long as that stock is working. But you always want to be prepared in case the stock turns against you suddenly. So another way to do that is to take partial profits. So you could have a rule, for example, if, say you're up 20%, your rule could be, I'm going to sell 1/3 of my position when I'm up 20%, and then I'm going to use staggered stops or trailing stops to manage the remaining 2/3. By doing that, you're now taking all the emotion out of trading. You've basically said, I'm locking in this 20% gain on 1/3 of my position. So you basically guaranteed yourself a win on that trade. And then the remaining 2/3, when you move the stop up or use trailing stops or however you're going to do it, you've now made sure you're at least not going to lose money on that remaining 2/3. You could put your stop for that remaining 2/3 at break even. And, again, now you've completely taken the emotion out of it because you've locked in a gain on 1/3 of the position, and you're going to just let the remaining 2/3 ride, but guarantee that you will not be able to take a loss on it. So there's different strategies you can do, and I talk about a bunch of these strategies in the risk management video. So I'll post that link here also so you can check that one out. But basically by doing that, you want to do whatever you need to do when you're trading to trade as mechanically as possible. You want to take all the emotion out of it. And a key thing to remember about this particular fear of leaving money on the table, look, you just need to accept the fact that you're never going to buy a stock right at the bottom, and you're never going to sell a stock right at the top. It's just not possible. There's no way to predict a bottom or a top. What you want to do in trading is you want to catch that middle section. The middle section is where you're making the most money, not by trying to bottom pick or top tick a stock. So how do you trade without emotions? Look, it's really important. Never measure your self-worth based on each individual trade. And what I mean by that is, again, this kind of goes back to the fear of being wrong. And it's a common mistake among retail traders. You can't look at your success as a trader based on one individual trade. You need to look at the aggregate of all your trades combined. And so if you're using your trading plan, and if you're using proper risk management, then even on the 30, 40%, it could even be 50% of your trades that you could be wrong on, you're still going to be making money. So you want to treat trading like a business, not a hobby, or you don't want to treat it like a gamble. You need to have a strategy for every trade. You need to have predefined risk with an exit strategy. And that'll really help take all the emotion out of trading. And like I mentioned, you want to make trading completely mechanical. The less decisions you need to make, the better your performance is going to be. Look, if you're constantly having to make decisions on when to enter and when to exit, and you don't really have a clear set pattern that you're looking for, or a clear set defined rule that you're looking for, then you're constantly making decisions. And the more decisions you make, the more times you're going to be wrong. And so having a solid strategy, having a good risk plan will make it way easier to manage your emotions. So that's all I have for this video. Hopefully that was helpful. Hopefully that gave you a better understanding now of how emotions play into trading, and understand the psychology of trading. Check out my other two videos on how to put a trading plan together and how to create a risk management plan. Because really you need all three parts. You need the psychology of trading, but you also need to understand the technical side of trading. If you can master all three of these together, you're going to be very successful over time. The key is to follow your strategy, follow your risk plan, and to do it in such a way where you're removing as much emotion as you can from trading. So again, hopefully that helps. If you enjoyed this video, please click the like and subscribe buttons, and we'll see you next time.